3 seconds after the market opens, somewhere in the world, a fund collapses, a bank quietly freezes withdrawals, and a trader deletes a message he should never have sent. And you don't hear about any of it until months later, when headlines suddenly say, "Unexpected crisis." The truth is, financial crises never begin when the news tells you they begin. They start slowly, invisibly, while everything still looks normal. Right now feels stable, markets moving, apps showing green numbers, influencers talking about opportunity. But stability in finance is often just calm built on borrowed time. Every major crash in modern history followed the same pattern. Easy money first, confidence second, risk last. After years of low interest rates and massive liquidity injections, money became cheap, almost free. And when money feels free, people stop asking hard questions. Companies borrow to grow faster than profits. Investors chase returns instead of value. Banks package risk into products that look safe because complexity hides danger. In 2008, it was housing. In 2000, it was tech stocks. Before that, leveraged funds and currency bets. The details change, but the mechanism stays identical. Debt expands faster than reality. Here's the uncomfortable math. Economies grow slowly, usually 2 to 3% a year, but financial assets can inflate 10, 20, sometimes 50% because prices are driven by expectations, not productivity. That gap must eventually close, and when it does, it closes violently. The irony is that crises are not caused by panic. Panic is just the moment everyone realizes the system was fragile all along. Banks don't actually keep most deposited money. Markets depend on confidence more than cash, and entire economies run on the assumption that tomorrow will look similar to today. When interest rates rise or liquidity tightens, that assumption breaks. Suddenly, refinancing becomes impossible, asset prices fall, collateral loses value, and institutions that looked strong yesterday start selling anything they can just to survive. Contagion spreads not through bad decisions alone, but through interconnected balance sheets no one fully understands. Meanwhile, the average person notices it last, through layoffs, higher prices, frozen investments, or savings that quietly lose purchasing power. The strange part is that warning signs are always visible beforehand: rising debt levels, speculative bubbles, record optimism, and experts confidently explaining why this time is different. History suggests it never is. Yet each cycle convinces a new generation that risk has been engineered away. Technology changes, regulations change, human behavior doesn't. And today, global debt sits at levels higher than before previous crashes. Markets react instantly to policy shifts, and financial systems are more connected than ever, meaning shocks travel faster and farther. The next crisis will not look exactly like the last one, which is precisely why most people won't recognize it forming. It may begin in private credit, government debt, commercial real estate, or somewhere nobody is currently watching. By the time it has a name, the damage will already be done. The real question is not whether another financial crisis will happen. History answers that clearly. But whether we will notice the warning signs while there is still time to understand what is actually breaking beneath the surface.